Again, after like recording starts, you again confirm me whether you can see the screen or not. Okay. Now can you see the screen?
Yes, sir.
Yes. Yes, sir.
You can see perfectly. Correct. Okay. Okay. That's fine. Now see. So yesterday we started with current ratio. Today, like we are going ahead and we are starting with quick ratio. Today we are continuing our class and we are going deeper into the liquidity aspect. Okay, we are checking the liquidity position. We were yesterday checking the liquidity position of Geo company with the help of current ratio. Today we will check the liquidity position of Geo company with the help of quick ratio. Okay, so quick ratio is also called as acid test ratio. I already told you there's a slang like acid test is a slang actually used by Englishmen to show something. It's a quick test actually. In olden days, goldsmiths or goldsmiths used to like do acid test to check the metals, like the quality of metals. Okay, so they used to do that test and they used to get immediately. They used to know or they used to confirm the quality of the metal. So since that was like acid test and here we are studying quick ratio. So with quick test came the acid test. So quick ratio is also called as acid test ratio. Okay. Now coming to the formula for quick ratio, the formula is quick assets by current liabilities. Okay. Now the question what comes to your mind is what is a quick asset? So quick assets are some assets which can give you economic benefits even within more shorter period of time than current assets. Okay. So yesterday what we discussed, current assets can give you economic benefits within a year. Am I right? Within 12 months, isn't it so? Please tell me. This was a standard. All of you can see the screen.
Yes, sir.
Yeah. So within 12 months, if some asset is giving you economic benefits, it's called current asset. But quick assets is a refinement to current asset. How it's a refinement? First of all, we took all the current assets under current assets, correct? Now in quick assets, we are going to exclude some two like current assets. What are those two current assets we are going to exclude? Inventory and prepaid expenses. Fine. Now, from current assets, total of current assets, if you exclude inventory and prepaid expenses, the formula is written here, you get quick assets. Okay. Or else if you want quick assets, you take all the current assets, but except inventory and prepaid expenses, all the current assets, when you sum them or you add them, the total what you'll get will be nothing but the quick assets total. Okay, or total of quick assets. Now, current assets can give us economic benefits within 12 months. Quick assets can give us economic benefits even quicker than current assets. So I can say within 6 months. So these are more refined assets. Okay, that means we can check the liquidity of Reliance Jio even more sooner with the help of quick assets or quick ratio. Now, why did we exclude inventory and prepaid expenses? Even that is a big question to be answered. See, inventory happens to be such a current asset which is more tangible in nature. Tangible in nature. Why? What do you mean by tangible? Tangible is nothing but something which you can touch, which you can physically see, you can sense. That is called tangible. Inventory is nothing but stock for a business, and stock is nothing but it is a physical thing which is what you buy and you store it in your godown or in your shop. And you see that this definitely is a kind of a current asset which is highly tangible in nature. Point number one. Point number two is there is no confirmation about the status of inventory when it will be converted into cash. That means sometimes inventory can be the entire inventory can be sold within a very short span of time. Sometimes it may take very long time to sell the entire inventory. That's the reason why we exclude this inventory from the category of quick assets. Point number two. Prepaid expenses. So inventories we have discussed. Prepaid expenses are such assets for which the payment has already been made and we are yet to enjoy the benefits for those payments which we have already made. And that when are we going to enjoy? When is that going to happen? And this is already done in advance. and the benefits depend upon the future. So that is also there's no confirmation for that time period. Henceforth, we exclude this from the category of quick assets. So that means except these two, all the current assets which I have given the list yesterday come under the category of quick assets. Okay. So now coming to the ratio, see what is the ideal quick ratio for a business? The ideal quick ratio for a business is 1:1. Now, why 1:1? Please try to understand. See, now yesterday we took current ratio and in that we took 2:1. Okay, ideal ratio. Today we are taking quick ratio and we are taking 1:1 as ideal ratio. See, in this 2, inventory was also present. Am I right or wrong? If I take 2 lakhs as current assets and 1 lakh as current liability, in this 2 lakhs, I have inventory also included in this. Please tell me yes or no.
Yes,
I'm
sir.
asking.
Yes,
Yes, of course, that 2 lakh has inventory also in it. Okay. Now, inventory is a major asset for a business. If you exclude that inventory from this 2 lakh, major portion of asset is removed from this. Henceforth, you will be left over with a smaller amount of asset with you, correct? Smaller amount of asset. So here that like the exclusion of inventory from the total current assets and as well as the prepaid expense also will reduce your current ratio to a higher extent. Okay, that means to a more like more downer side you'll be seeing your ratio. The point here is if my total of current assets is 2 lakh and inventory which is a major asset for my business, if I remove that like 1 lakh from this, so I am left out with 1 lakh and I have my liabilities of 1 lakh. So my ratio would be 1:1. Okay. So what does this 1:1 ratio mean? Same interpretation we can draw for this ratio even. What is the interpretation we can draw? If I have quick assets worth of 1 lakh and my liabilities or obligation are worth of 1 lakh, if I want to repay my obligation or my debts, I have enough resources that too within a very short span of time to repay that obligation. So the point here is, of course, this is one of the measures of liquidity, not the complete measure of liquidity, because current ratio is also one of the measures of liquidity. Quick ratio is also one of the measures of liquidity. What we are doing is we are doing refinement here. That means we are checking whether we have the capacity to pay like in a longer period of time, and also we are checking in a short span of time how much capacity we have to repay the debts or obligation what we have. So here, since quick assets are such assets which give you economic benefits within a very short span of time when compared to current ratio in 6 months. So if we have these assets, definitely we have resources to repay our debts within a short span of time. And if that is the case with the company in which we are going to invest, we are looking, definitely we are very much confirmed about that company's liquidity position. That company has a strong liquidity position. That means if it repays that $1 of liability with $1 of the quick assets what it has, definitely it is very strong company in terms of liquidity. Please tell me, did you understand this concept or not?
Yes,
Hello.
sir.
Yes, it's clear.
yes,
Yeah.
sir.
Let's go ahead with the last and final ratio, that is cash ratio. I'll write down some points here. Current ratio, cash in hand, plus cash at bank, plus inventories, plus marketable securities, plus outstanding income, plus prepaid expenses, plus receivables. So these are all your current assets under current ratio. So I'll write current assets. Okay. Now when it comes to quick assets, I will take cash in hand. I will take cash at bank. I will take like marketable securities. I will take outstanding income. I will take receivables. So what I didn't take? I didn't take prepaid expenses. I didn't take inventory. Please tell me yes or no.
Yes.
Yes or no? Yes. Now when it
Yes.
comes to cash ratio, so cash ratio, I will take only the most liquid assets. Okay. I will take cash in hand. I will take cash at bank. I will not take inventories. I will take cash equivalents, which are marketable securities. I will not take outstanding income. I will not take prepaid expenses. I will not take receivables. So what I mean to say here is cash ratio is nothing but cash in hand plus cash at bank plus marketable securities, that can also be termed as cash equivalents whole divided by current liabilities. Okay, this is the ratio. And what are we trying to see with the help of these ratios? See, current ratio, we took we took the current assets. What were the current assets? Current assets are such assets which will give you economic benefits within 12 months. Then we took under these are the current assets. Then we took quick assets which can give you economic benefits within 6 months. Now we are taking liquid assets which can give you economic benefits within what? Can I say immediately? Yes or no?
Yes. Yes, sir.
Yeah, so liquid assets are such assets which can give you the economic benefits immediately. You need not wait for even a single day or 1 month or 2 months or 3 months, because this is cash, this is cash, this is almost cash, correct? Now, point number 1 is clear for you. Point number 2. What can be the ideal cash ratio for a business? Of course, the ideal cash ratio is 0.5:1. Now, why 0.5:1? Let's take an example. Case number 1, case number 2. So here, Mr. A wants to buy an apartment. Okay. The cost of the apartment is 50 lakhs. Since Mr. A wants to buy this apartment for whose cost is 50 lakhs, Mr. A has to make a down payment to bank of some, let's say 25%. Okay. How much percent? Let's say 20%. Fine. So Mr. A has to see, Mr. A wants to buy an apartment. For that, Mr. A wants money. Mr. A approaches the bank because he doesn't have the entire money to pay for that flat or apartment. Bank definitely would finance Mr. A, but the precondition to finance is you make the 20% down payment. We will give you the 80% funding. Okay. Now bank is ready to pay how much to Mr. A? 40 lakhs, correct? So 40 lakhs is the loan amount bank has sanctioned to Mr. A. Now, case number 1. See, please understand, very, very important case. So Mr. A has a liability of 40 lakhs. In this case also, Mr. A has a liability of 40 lakhs. And Mr. A has 30 years to repay this loan because he's a young man. He has taken a loan in a very early age. Even you, when become you become ACCA in your career, you will join a good job and immediately you can try to buy a house. Okay, because you get good package and then loans become easy for you to procure. Okay, now so 40 lakhs is the loan amount and 30 years is the timeline whereby Mr. A can repay this amount. Now the prime question here is, case number 1, Mr. A has 20 lakhs with him. Case number 2, Mr. A has 2 lakhs with him. In both the cases, in which case Mr. A is very strong, financially very strong? Come on, tell me. This is the liability, this is the asset what he has, and this 20 lakhs and 2 lakhs are nothing but cash. He has cash. I'm not speaking about other assets. He may have some receivables. he may have invested. Okay, let's say he has done some smart thing. What smart thing he has done is 5 lakhs he has cash and 15 lakhs he has in form of SIP, systematic investment plan, mutual funds, stocks, etc. I will say all these are securities. Here he has just cash. Now tell me, in both the cases, in which case Mr. A feels very stronger. That means he is more confident in his life. Financially, in which case he is more confident? He is confident in this case, correct? Why?
Yes.
Because the loan which he has to repay is 40 lakhs. And of that liability or loan, he holds 20 lakhs immediately today. That is there in his hands, correct? And here he has a liability of 40 lakhs and he holds just 2 lakhs. And when Mr. A would have an emergency, let's say someone in Mr. A's house has got hospitalized. Someone has met with an accident and has got hospitalized, and the hospital is quoting, or hospital has billed him 8 lakh rupees. So that 8 lakh rupees he can easily pay from this. But can he pay from this? No. Again, he has to take a loan in XYZ. But given the time period he has of 30 years, and he is holding 20 lakhs, that is 50% of his liability, whatever he has, 50% of the liability, whatever he has, he is holding that much of cash in his hands. Now you'll ask me a question, sir, he is a very stupid person. Why he did not pay the amount here to the bank? Leave those questions right now. Why I'm saying that is, people in the world have different mindset. You can guide them, but you cannot force them to do what you want them to do. You can guide them, you can give them guidance, but you cannot force them to do what you're saying to them, correct? You can be advisor, but you cannot be you cannot be someone who can like pressurize people to do that, what you're saying. So point here is, he is very safe in this case. Why? Because he has 50% of funds with him immediately. Okay, and he has good amount of time to repay his loan whenever he wants. Okay, like he has got 30 years of time, and he holds 50% of cash for the entire liability what he has to repay. So does it show he has does it show, if I just calculate the ratio, is it 0.5:1? Correct or wrong? Of course, 20 by 40 is how much? Cancel 1/2. 1/2 is how much? 0.50. Correct or wrong? Is to 1. Please tell me yes or no.
Yes.
Hello.
Yes, sir.
Is it not 0.50 is to 1? Yes. Now, if Mr. A wants to repay his liability, he has 50% cash to repay. That means if he has to pay 1 rupee as if he has a loan of 1 rupee, 50 paise he can immediately pay, and rest he can pay in future whenever, because he has some other assets also. I did not say that he doesn't have other assets. I'm not saying that. He can easily pay in the future also. But today, immediately he has 50% of the cash of the entire liability, whatever he has. And that is termed to be very strong in case of with respect to liquidity standards. Okay, that's the reason why they say 0.50:1 cash ratio is very ideal for a business. Now, so did you understand this concept? Anyone has got any doubts?
No.
Hello.
Understood, sir.
Understood. Okay, Hoor and Fatima and Hamsika, everyone clear? Okay, so we'll go into the questions now. Yeah. So we are doing the last chapter of this book. Okay. Interpretation of financial statements. Okay, we are into the chapter. So we started with liquidity. Let's go into this particular liquidity now. So this is what we were discussing, current ratio, also called as working capital ratio. Okay. We discussed everything about this current ratio. We discussed about the quick ratio. And we discussed about cash ratio, which they have not given, but okay, fine. I have already explained you. Now let's go into the next ratio, that is efficiency ratio. Okay, let's discuss that. I really pity they did not give any question to solve. It's not good actually from their part to do. Okay, so can I give you some question right now to solve current ratio and quick ratio? Can I give you a question? Will you solve that? Hello?
Yes, sir.
Yes, sir.
Yeah, just a second. Okay. So like this is your financial statement. I want you to find out the current ratio and quick ratio from this. Will you do this? Okay,
Yes,
do
sir.
this. Yeah, do this. By the way, no need to okay, they have already given you the current ratio. Okay, we will do this question afterwards. Why I'm saying that is, see, this particular question needs to be done with some changes. Okay, so what they meant to say here is in 2004, this year, they have calculated all these ratios which are given to you here. And what they are asking is in 2005, some changes have happened. Online food home delivery increased by 25%. That means what kind of company this is? You know, today we have lot many startups which are working. So TGF is a national supermarket chain selling food, clothes and household appliances with a 31st December year end. The finance director would like the management accountant to prepare some financial data and analysis to present to board. They have provided the management accountant with extracts from the financial statements to assist them in this analysis. So these are the extracts. These are the income statement items of 2004. These are the income statement items of 2005. Now, many of you are just looking like what is this income statement and all this. Like first chapter, I've explained you what is income statement. I've given some hints. Okay. So they have given this, okay, and as you clearly know, this is a online delivery thing, correct? See, TGF is a national supermarket chain, so they do online deliveries even. So now, what they are saying is online food home delivery increased by 25%. That means previous year, whatever the ratios they got, these are the ratios which are calculated. Okay, so why don't you do one thing? Very simply, current assets. Here we have total of current assets. Here we have total of current liabilities. When you divide this to, what is the ratio you're getting? Please tell me. This question we cannot do completely because there are many ratios to be solved. So until unless we don't finish all the ratios of this chapter, we cannot do that because we have to make some changes in 2005 statements and we have to calculate. So can you calculate the current ratio from this for 2004, please? And as well as quick ratio. I'm waiting. Hello, what are you doing?
So 0.6:1.
0 point, yeah. When you divide this total of current assets by this current liabilities, you get 0.61. Okay, 0.61. Can you do quick ratio for this?
Sir, 0.2.
Yeah, so for that, what you need to do is you need to take total of current asset, which is 1610. You have to remove this 1000 of inventory. You get 610, and then you have to divide with total of current liabilities, which is 2650. Now you can see what you're getting. So 0.23 you will get. Did you get that? That is the
Yes,
quick
sir.
ratio. Hello. Yeah. So fine. Now let's not go into this. Why? Because until unless we finish the entire chapter, because they're asking so many ratios and changes have to be done for that. So we will do that in like tomorrow's or day after tomorrow's class. I'll solve this entire question for you. Okay. So what they're saying is you have to increase your revenues by 25%. You have to do that change. So these are the small changes you have to do. I'll explain you that one. Don't worry. 1 or 2 or 3 changes are there. That's it. Now, next part of the ratios, what we need to discuss is profitability ratio. Okay. So this is the first ratio what we are going to discuss under profitability ratio, that is gross profit margin. How will you find out gross profit? See, to find out gross profit, we have to make a small income statement. Okay. So we'll start with revenue, and then from revenue, we will remove COGS, cost of goods sold. What is the formula for cost of goods sold? It is opening inventory plus purchases minus closing inventory. So we'll put everything here. We'll remove this from this particular figure and we get the profit called gross profit. Okay, so this profit what we are getting here, don't worry, I'll explain you this in with numbers even. Okay, let's say like we bought 100 boxes and we bought these 100 boxes for $10 at the rate of $10 each. So how much does 100 boxes cost you? Can I say this is $1,000? Please tell me. Yes.
Yes, sir.
Now I'm selling these boxes at the rate of $12. So if I sell 100 boxes at the rate of $12, my revenue is how much? Revenue is $1,200, correct? How I got that revenue? 12 into 100. So one box I'm selling at $12 and I'm selling 100 boxes. There's no closing inventory in this. Please try to understand this example. No closing inventory, no opening inventory. So this cost is nothing but my purchase now. Please tell me. Hello. Hello.
Yes, sir.
Yeah, this cost is nothing but my purchase cost, isn't it? So yeah. So when I deduct this purchase cost from my revenue, I'm getting how much? $200. That is my gross profit, correct? In this case, there was no opening inventory, and no closing inventory. Just we purchased some boxes for $1,000. We sold boxes for $1,200 and the profit what we got is $200. Okay. But now let us change the case. Let us now go into let us now assume that we have a closing inventory. What do you mean by closing inventory? The entire boxes which I bought, I'm not selling them. I'm selling some part of it and some part of the boxes are left over. Correct. Now let's say I bought 100 boxes. And out of these 100 boxes, I sold 80 boxes. So how much is the closing inventory? 20 boxes. Please tell me yes or no. Closing inventory is nothing but the leftover inventory which you haven't sold right now, which you can definitely sell in the future. Please tell me, did you understand this?
Yes, sir.
Yeah, we are continuing now. So the same thing like dollars. Okay. Now what we'll do is revenue. So how much boxes we should consider, Hamsika? We are selling how
Sir,
many
your-
boxes? Can you hear me?
Yes, sir.
Yeah, how many boxes we are selling now, Hamsika, in this?
So we're selling 20 boxes.
20
Sorry, 80
boxes are 80 boxes. So we will take revenue for 80 boxes or 100 boxes?
For 80 boxes.
80 boxes. So 80 into 12 makes it 960. Okay. Now let's COGS. Under COGS, here also the purchase cost was under COGS. So COGS is nothing but you know what is COGS? Opening stock or opening inventory plus purchases minus closing inventory. Do we have opening inventory in this? No. Opening inventory is nil. Purchases. How many boxes you purchased? How many boxes you purchased? 100 boxes.
100.
So can I take 100 boxes? Yes. So purchases 100 boxes into each box costed me how much? $10. Okay. Minus how many boxes I did not sell? 20 boxes. So closing inventory 20 boxes, each box costing $10. This is selling price. These are cost. So how many boxes now I have? 80 boxes. That means 100 I bought, 20 I did not sell. So how much I sold? 80. So I have to take the cost of 80 boxes only. Am I right? 80 into 10, 800. So what is your profit now? 160. This is your gross profit. Understood? Hello?
Yes, sir.
Yeah. Okay. So many students are very much confused. Like why we subtract this closing inventory from cost of goods sold? Do you had this doubt or not previously? Hamsika, did you have this doubt or not previously?
Yes, sir.
Many students, they get a doubt why we subtract closing inventory. The reason why we subtract closing inventory is we take the entire boxes here that we have purchased and we remove the boxes which we did not sell. Okay, so definitely we sold how many boxes? 80. We took the revenue of that, and with that, with the revenue of 80 boxes, we have to compare the cost of 80 boxes. So the cost of 80 boxes is 800. So revenue minus cost is profit, that is gross profit 160. Come on, make a note of this. After like finishing this, tell me, we'll move forward.
Yes, sir. Done.
Yeah. So now, what is this gross profit all about? See, gross profit, why it is called gross profit is because it is not the net profit. Now, why it is called gross profit? This profit needs to be adjusted to reach to net profit. Okay. Why like the name has come as gross profit is this is not the final profit of your business. The final profit for your business would be net profit. Understood? The final profit for your business would always be your net profit. This is the profit which you have earned from your prime activity. See, let's say this particular whatever I have discussed with you, this is a sole trading concern. So what is a sole trading concern? Sole trading concern is nothing but the business which has single seller. Okay, he brings the goods and he sells to people. He is doing what? Trading. What is trading? Buying and selling. So definitely he bought how many boxes? He bought 100 boxes. He sold how many boxes? 80 boxes. And he has compared the The revenue what he generated from 80 boxes is 960. And how much did the 80 boxes cost him? 800. How much is the profit he made from the business? 160. But do you think this is the final profit? Do you think this is the
No.
final profit? No, this is not the final profit. This is why this is not the final profit means now there are certain more expenses which we need to deduct. Okay. See, till here we have only considered the prime activity of this trading concern. The prime activity is trading, that is buying and selling. But do you think, like for example, if I take a manufacturing company, what is the prime activity of a manufacturing company? Manufacturing. Please tell me yes or no.
Yes, sir.
Yes, the prime activity of a manufacturing company will be manufacturing. Though, and the expenses what you will be incurring, the expenses which I will take under prime activity would be direct expenses. What is that?
Direct expense.
Direct expenses. Now, what is the difference between direct expense and indirect expense? See, direct expenses. So I will take a small example for you to understand this concept. This is a factory and this is a manufacturing concern. Okay. In this factory, what happens? Manufacturing happens. Can I say that is the prime activity of this manufacturing company? Of course. So there is a machine here. This machine is operated by 4 laborers. Okay. Labor number 1, labor number 2, labor number 3, labor number 4. So there are 4 laborers who are working on this machine. So whatever the wages we pay to these 4 laborers, can I say them those are nothing but direct wages? Please tell me yes or no. Hello.
Yes, sir.
Why
Yes.
these are why we say them as direct wages? Because they are
They're direct.
directly working on that machine, which is nothing but the factory entirely is nothing but about that machine. If there's no machine, there's no factory. That machine is the machine itself is a factory. See, factory is an establishment whereby they put the machine, they make a shed and they do this production. But those shed and all doesn't matter. What matters in this factory is machine, and the people or the labor who are working on that machine, to them we pay direct wages because they are directly involved in my manufacturing activity. Point number 2. There is a security guard who is giving security to this entire factory premise. We pay wages to this security guard even. But what wages we pay to him? Can I say that is indirect wages?
Yes.
But why that is indirect wages? Because he is not involved directly in this production process. He is giving security to this production process. That means he is supporting that direct activity. So when someone supports the direct activity, he is not involved in that activity directly. He is indirectly involved in that activity. Am I right or wrong? He is coming to factory. He is every day coming to factory, but he is not doing the production process. He is giving security to those production process. He is giving the security to this production process. That means he is not a machine operator, not directly working on that machine, just supporting those particular laborers or workers or machine operators who are directly involved in operating that machine. If he doesn't give that security, maybe they will not work, some theft may happen, or the work may get interrupted. So is he supporting that direct activity or not? Please tell me.
Yes.
Easy. Yeah. So someone who supports the direct activity, okay, is not directly involved in that activity. He is just supporting it. So whatever the expenditure, like whatever expenditure we incur in this case are called indirect expenses. Here we write support activity, supporting the direct activity. So whenever there is a support given to direct activity, that activity is called indirect activity. But here the wages what we are paying is indirect manufacturing wages. This was direct manufacturing wages. Okay. Now I'm coming to third point because now I'm going to conclude this concept for you. Okay. Why I'm putting so much efforts is Many students doesn't even know the difference between direct wages and indirect wages. So I have to explain them now. Point number 3. See, do you think the factory is enough to run a company? No. Factory is a very important aspect of a company. To run this company, the directors, who runs this company? The directors. Am I right? Not the workers. Because directors, they make the policies for this company, and they make the policies in factory or in their office. Office, correct?
The office.
You hear this word now? Head office, branch office. Okay. So the directors of the company are always in the head office. And do you think director works alone or he works with a team? Team. So there is a director. Under him comes the CEO. Then comes the CFO. Then comes the manager. Then comes the assistant manager. Then comes the deputy. All this then comes the officer. Then comes the supervisor. All this goes on. So all these people work in office. So are they directly involved in the production activity? Please tell me. Are they involved in this production activity? Are they involved? But still they are associated with this manufacturing. Still they are associated with this activity or not? Of course, yes. Why? Because in accounts office, the accountant will make all the records of whatever is happening in this factory. How much raw material has come, how much inventory is utilized in this factory, how much wages are paid to these laborers, everything who will record? The accountant. Where he will record? In his accounts department. And where that accounts department comes? In this office, correct? So these people are doing the back end work for this factory. Since they are not directly involved in this production process, but of course they are indirectly involved in this production process, we pay them. Okay, we pay them, and the expenditure what we incur in this case are indirect administrative expenses or overheads. Understood? Please tell me yes or no. All of you,
Yes,
hello.
sir.
Yes.
Yes,
So this was the detail. Make a small note of this, and then I will explain you 3 ratios: gross profit ratio, operating profit ratio, and net profit ratio. You'll understand all the concept clearly. Okay, please make a note of this.
Yes, sir.
Yeah. So now the point here is, again we'll come to this ground zero: gross profit, operating profit, and net profit. Okay. Now we started with revenue and we deducted COGS. Under COGS, we took opening inventory. We took purchases. And if there is any direct expense. So I have already explained you about direct expense right now, correct? Direct expense are nothing but direct material and direct wages. These are the only direct expenses what you have. Okay. So direct expenses minus closing inventory. Actually in ACCA books, they are very simply giving the formats. Just a second, I'll connect the chart. So I take up this F7 classes. So in that they have given a very simple format. By the way, I can share you my videos of financial reports. Today I'll try to share. You go through that once. You'll get good basics from that. Yeah. So here again, I took direct expenses. In your ACCA books, they are giving just revenue minus COGS gets you gross profit less all expenses. In all expense, in all expense, see, sorry, they add other incomes. They did not tell what is this other income all about. So of course that is F7 book. F7 book is financial reporting book. It's not meant for basics. Basics you have to learn from F3. Less like all expenses and you get net profit. That's what they give. Okay. So in one of the cases, but don't worry, we'll go with basics. So here's less COGS. We have opening inventory, we have purchases, we have direct expenses and less closing inventory. We get a figure here. And that figure when we deduct, that's called COGS. Revenue minus COGS is gross profit. And what is this gross profit? It is not the final profit of the business. It is the profit earned from the core activity of your business or prime activity of your business. Prime activity for a manufacturing firm is, manufacturing company is manufacturing, whereby they use inventory, they purchase raw material, they make like they also purchase. See, opening inventory and purchases can come under direct material. They make wage payments to their laborers. Okay. And then they may be left over with some inventory. So all these things they are incurring on their prime activity. So when I remove these expenses from revenue, the expenses which they have incurred for prime activity from this revenue, I get a profit called gross profit. So can I say this profit is the profit which I earn from the prime activity of the business? Yes. But this is not the end. I have to go further more because I have to refine this, because this is not the end in my business. I will incur some more expenses in the coming in the coming lines. Okay. Now, what are the other expenses which I will incur in the which I will incur in my business? Of course, indirect expenses. So any indirect expenses, whether it is manufacturing or administrative and all, you will remove from gross profit. Correct? Please tell me yes or no. So I'll write it here. So less operating, administration and selling expenses. So when I remove all these expenses from gross profit, the profit which I get is called what? Operating profit. Please tell me yes or no. All of you. Hello.
Yes, sir.
So why this is called operating profit? Why? Because I removed all the indirect nature expenses from gross profit. So the next profit which I got is operating profit. Now this is not the end. To this operating profit. Why is this called operating profit? This is also called as PBIT, profit before interest and tax. Why it is called PBIT as well? Why? Because now there are some expenses which I need to remove from operating profit to get my net profit. Okay. So why didn't I take those expenses here? Because those were not the expenses. Those were not the operating nature expenses of my business. That's the reason why I did not take them under operating, administration and selling expenses or overheads. So what are those expenses which are not under this category? If of course those expenses are called finance expenses. What are they called? They are called what? Hello?
Finance expenses.
Yeah, finance expenses are also called as non-operating expenses. But why? Because see, if you pay wage, like if you are paying salary to your employee, he is working in your company. Of course, that's an operating nature expense for you. If you are paying the office rent, it's you are paying the rent, of course, for your business which you are operating, and it's an operating nature expense. If you are paying legal charges, if you are paying for printing and stationery, if you are paying for postage and telegram, all the expenses what I'm mentioning, you are all operating administrative expenses. Or if you are paying for marketing, promotion, branding, advertisement, those are called selling expenses. But do you think we take finance very often? We take finance once, correct? And do you think your business is a banking business? I'm speaking about which business here? Manufacturing, correct or wrong?
Correct, sir.
Manufacturing business activity is nothing but they will convert the raw material into finished goods. But are they involved in financing? Do they give loans to people and they take loan, of course. Do they finance people? No. So
No.
finance expenses can be a operating nature expense for a bank, but not for a manufacturing company. So finance expenses are purely non-operating nature expenses, which we will deduct from this less finance expense. And any incomes which we are earning in form of interest, okay, interest received, because see, you are a company, you may earn profits, you may have some savings. What will you do with those savings? You will invest and you'll get some income from that, correct or wrong? Do you think that income what you're getting from your investments is your income which you got from your business? No, you got from some other source, isn't it so? Come on, tell me.
Yes, sir.
I am running a business. I have some savings. I have invested that money in some other company's stock, or I have bought some securities of some other company. So since I have invested in their companies, they will give me some returns or not? Yes, those returns are my business returns, or I'm getting those returns from some other business, that is not my business. Okay. I'm just an investor in that company. So, or my company is an investor in that company. So interest received, dividend received, these are all non-operating nature incomes. Okay. So we will add them and we will subtract the non-operating nature expense, which is finance expense. Okay, some more examples. Suppose your business has an asset, a land, which is like in outskirts, which the company has bought some 20 years back. Its value has increased many-fold, and now the business wants to sell that land, and they are earning a profit from that. Do you think this is my business activity? No, selling plots is not my business activity. Selling land is not my business activity. My business activity here in my example is manufacturing, whereby I convert raw materials into finished goods. So that profit which I'm getting from sale of land is nothing but a non-operating nature income. So here also I'll write profit on sale of land. And in that case, if I get some loss, it's a non-operating nature expense. So loss on sale of land. Finance expenses like interest paid and all, you have to write it here. Okay. So then after adding up everything, I get profit before tax, PBT. Okay. Then I will just deduct the taxes. I will get the final profit, which is PAT or net profit. Okay. This is the final profit of my business after deducting all the expenses from gross profit. Okay. What all expenses? Operating, administration and selling expenses, as well as non-operating nature expenses, which are nothing but the finance expenses. Okay. Forget about the incomes. Definitely we have to add those incomes to profit, because profit is a positive figure. You add positive values and you deduct the negative values. That's a common sense. Okay. So please make the note of this format. This is very important format for your income statement, which we are going to study afterwards. Okay. I have given the basics to you how to find out these three profits, and now we can go for the ratios. Come on, write on this one. I'll scroll it down when you require. Okay.
Yes, sir.
Okay, so shall I scroll it down?
Yes, sir.
Tell me, yeah, now I'll scroll it down. Okay.
Done, sir.
Yeah. All of you, Hoor and Fatima, have you finished?
Yes, sir.
Yes.
Yes.
Yeah. Great. So like now let's go for the ratios what we were looking into. So like here I'll just put all those ratios like in one line. So gross profit margin or gross profit ratio, whatever you want, you can say gross profit margin is gross profit by net sales into 100. Okay. And operating profit margin is operating profit by net sales into 100. Okay. And net profit margin is net profit by net sales into 100. And you know very well how to find out all these profits. Gross profit is revenue minus COGS. Okay. And operating profit is gross profit minus administrative, selling and administrative, operating and selling and distribution expenses. And like how you get net profit, operating profit, add like other incomes, some other incomes or non-operating incomes, and subtract non-operating expenses which I mentioned you like finance expenses. Okay, just make a note of all this. And what does it mean? See, let's say your gross profit is 30,000, like let's say it's 40,000. Okay, divided by net sales, that is 100,000 into 100. Your gross profit is how much? 40%. Correct? Isn't it so? Yes. Hello.
Yes, sir.
Yeah. So can I write here gross profit can also be said as excess of revenue over COGS? Can I say this? Can I say this or not? Excess of revenue, of course. If my revenue is 100,000, okay, if my COGS is 60,000, my gross profit will be how much? 40,000. Please tell me yes or no.
Yes.
1 lakhs minus 60k, 1 lakh minus 60k is 40k, of course. So excess of revenue over COGS is what? Gross profit. So excess of revenue over COGS means you have got a revenue of 1 lakh. From that you have removed these expenses So you got one profit right now. This is not the final profit, correct? So I'll just give you a small brief of this. See, not brief, like I'll give you a small explanation of this. So revenue is 1 lakh minus COGS is 60K. So your gross profit is 40K. How much your gross profit, how much your revenue is like excess of your COGS? 40K, correct? And that 40K is what your gross profit? Please tell me yes or no.
Yes, sir.
That means something which costed you 6 rupees, you sold it for 10 rupees and you got a profit of 4 rupees. But this is not the final profit, which because some more expenses have to be deducted now. I'll do that now. Okay. So here till here everything is all right now. Excess of revenue over COGS is gross profit now. Less operating, administration, selling expenses. So can I say excess of gross profit over this is operating profit? Let's say these are all 10K. So 30K I'm getting. So that is my operating profit. So what is my version of operating profit? Excess of gross profit over operating, administration and selling expenses, my operating profit. Please tell me yes or no.
Yes, sir.
Yeah, see, I'll remove here 1 rupees. I'll get 3 rupees. So how much is my gross profit excess of my operating, administration and selling expenses? By 3 rupees, correct or wrong?
Correct, sir.
Of course, then less. I'm just let us assume that I have no non-operating incomes. I have just finance expense. So my finance expense, which is non-operating expenses, 10K. So I get how much? 20K. So can I say excess of operating profit? Okay, what did I say? Excess of operating profit over finance expense is my net profit. How much is my operating profit excess of finance expenses? 20K, correct or wrong? How much is my
Correct.
operating profit excess of finance expense? How much it is more?
20K.
So did I recover all the expenses till now and I got net profit? Yes, I got net profit. Now I recovered all the expenses. Now see, till here I'm at 3 rupees minus 1 rupee. I'm getting 2 rupees. So my operating profit, which is 3 rupees, and my finance expense, which is 1 rupee, my operating profit is 2 rupees excess of my finance expenses. So this 2 rupees is what?
Net profit.
Finished. Okay. Now coming to ratios. Now this makes sense and it becomes very simple for you to do this calculation. So what makes sense? I was explaining you something in one line. Where is that?
Sir, does operating, administrating and selling expenses come under indirect expenses?
Yes, of course they come under indirect expenses. Yes. So 40% was my gross profit. I removed what? Here in my statement, I removed from here, from 40K, I removed 10K. I got 30K. Okay. That means I recovered. See, when I got my gross profit, that was not my final profit. Now what expenses I need to recover to get my operating profit? Operating, administration and selling expenses. Did I recover it? Yes. And I have enough profit to recover that? Yes. How I know that I have enough profit to recover that? Because I'm still having a positive balance of 30K in my account, which is my operating profit. Yes or no? Yes?
Yes, sir.
Yeah. So now operating profit. So my operating profit is 30,000 divided by 1 lakh into 100. That shows my operating profit is 30%. Okay. And finally my net profit. So my net profit, after that I will just remove my finance expenses and I'll get my net profit of 20K. That means I have enough profits to recover my this expense also. And the final thing what is left over in my hands is the net profit, 20K. Okay. So now net profit margin 20,000 by 1 lakh into 100. That gives 20%. Now, what is the interpretation for all this? let me just write it here. 40% gross profit margin, 30% operating profit margin, and then last was 20%. Na? How much? %20. 20% was my net profit margin. Now coming to the profits, there is no satisfaction or satisfactory levels in this entire world when it comes to profits. It is always, why should not I get more than this? Correct? If I tell you, if I ask you one question, are you satisfied with this 20% profit this year? You'll say, why, sir? If I would have got 30%, I would have been more happy. Is this the right statement or not? Do you think there is a satisfaction level of profit for a businessman? If you like some music, you want to listen it more and more. If you like something, you want it more. If you like whatever your hobby is, you want to do more and more that one. Correct or wrong? Please tell me yes or no. Come on, don't be mum.
Yes, sir.
Yeah. So there is no, for greedy people, for businessmen who wants to earn profits, there is no limit of profit. But then how to decide whether this is a good profit or not? Previous year, my business earned a profit of 10%. And this year, my business has earned a profit of 20%. Now, what do you think? Which is a better year?
20%.
That's it. So profitability ratios are not absolute measures. They are what? Relative measures. What are they?
Relative measures.
Yes, you can just compare and you can decide the performance, not with absolute numbers or percentages. Okay, so this is the end of these three ratios. Tomorrow we'll do questions related to them and also efficiency ratios. I'll wind up. Then we'll do that big question and we'll close this chapter. Okay, thank you. Then see you tomorrow in the evening at 7:30 or 8. Okay, bye-bye.
Yes, sir. Thank you, sir.
Thank you. Thank you so much, all of you. Bye-bye.